We are back with another episode of Very True with Verissimo Ventures. I'm Alex. Great to have everyone joining us again. And I'm really excited today to have one of my good friends, one of my colleagues, one of my thought partners, Ariel Menche, on today. And this is actually going to be the first in a series of podcasts because, frankly, we just have so much to discuss. It'll become really clear really quickly why we share so many of the same ideals, what the differences are in our backgrounds and how those are complementary, but also how sometimes those diverge. And we'll cover a number of other topics, which the hope is that we'll cover everything from fundraising to model building to accounting to expense management, even touching on things like HR and accounts receivable and some of the nitty gritty. But the hope is that we can provide perspective to both founders, to operational finance executives, to investors on how they should look at finance, how they should understand that this is basically the lifeblood of every company. And I'll elaborate on why I think that's the case and how important it is to get this right, even though it feels like it's not a core competence for a lot of people. We're both here. We agree that it is, and why that matters so much. Welcome to the Very True podcast. I'm Alex Oppenheimer, the founder of Verissimo Ventures, an early-stage venture fund investing in Israel and the US. Previously, I was a tech banker at Morgan Stanley and a VC investor at NEA. I then spent several years working directly with startups on finance, business models, RevOps, and more, before launching Verissimo Ventures in 2020. I got into this business because I enjoy working with founders and helping them realize their vision and fulfill their potential. I created this podcast to shine a light on the day-to-day reality that most people are too afraid to discuss. The pivots, the fumbles, and the so-called non-core aspects of building a business from scratch. Rather than focusing on the end of a successful road, we spend time here discussing the tougher, lesser-known parts of the startup lifecycle. The goal is to offer insights to founders to improve their startup experience, whether that means avoiding problems and finding success faster, or just feeling more confident and less isolated on their entrepreneurial journey. We will jump in now. I will let Ariel start with his background, how he got to where he is now, what he's currently doing in his company, and then we'll take it from there. So Ariel, I'll hand it off to you.
Well, thanks, Alex. Also, thanks for having me. I'm excited for this conversation as well. So right now, I'm the CEO of Raftel Strategy. We are an outsourced finance and strategy firm, strategic finance, if you will. We do CFO work, FP&A, which is financial planning analysis. We actually recently started accounting for both Israel and US entity companies and also help with a number of strategic projects, whether it's M&A advisory, helping with financial due diligence with acquisitions or helping companies on the sell side as well. But where I started, it was back in NYU Stern, the business school, studied finance, studied accounting, and also art history because, got to get both sides of the brain in there. I went straight into KPMG in the strategy team. At the time, it was kind of a startup within KPMG. I was one of the first 100 employees of the strategy team globally, not globally, it was nationally in the US. And I got to learn strategy consulting from partners from McKinsey, BCG, Bain, A.T. Kearney, Mercer, you name it. And I worked in almost every industry. Became known that I was the good at the Excel sheets. And so they kind of threw me into Excel and I was building out these models from pretty early on. I'm working in energy projects and defense and industrial manufacturing, retail. It was a lot of fun. But I eventually wanted to go in-house, so I joined the WWE. They didn't let me go in the ring, but at least they let me join the finance team there. And it was really cool. I got to work with Stephanie McMahon, and who was the chief brand officer at the time. And I helped manage the budgets for the marketing, the brand teams, and eventually the sales, and also the data analytics teams. And it was quite an experience to work at a public company that had a really cool product, as you know, wrestling. Worked there for a few years. During COVID, things slowed down. We eventually moved to Israel, and that's around the time we met, about 5.5 years ago. And been helping companies build models since. Helped with commercial strategies, pricing strategies. I come to the finance world from very corporate background in the sense that I see how these very large Fortune 100, Fortune 500 companies were working, how they're dealing with Wall Street, how they are using finance internally, very much like a nucleus of a company. CEO of the companies need to have a pulse on what's going on and to make business decisions. And they use their finance team as those arteries within the company to see what that pulse is and get the numbers that they could rely on, really, to understand what's going on. And this feeds into valuations, it feeds into capital markets, but it, feeds into the granularity of like what vendors can we be working with. So finance is one of those terms that means a lot of different things to different people, and people assume it means one thing. So actually, great example is that when I moved to Israel, I told people, hey, I do finance. You're hiring for a director of finance role, and they're like, great. Can you process my payroll for me? I was like, no, I don't know how to process payroll. That's accounting. That's not finance. They're like, what are you talking about? The finance and accounting are the same word here, pretty much. And so being able to differentiate for people what the difference between accounting work, bookkeeping, accounts payable, accounts receivable, payroll versus strategic work like finance, being able to model out budget and all the different pieces is really important. And it's kind of some of the work we're doing today.
So a fun story that I think is worthy of sharing, which is that Ariel and I got introduced the summer of 2020. This was like deep Corona. I had just had my first kid. We did one of these like sketchy, empty flights to America to visit our families. We're driving up and down the East Coast, and Ariel and I met, and we had a phone call, and it was like, okay, wow, yeah, cool. And frankly, this happens to me a lot. I've been in Israel for 10 years. Anyone who's like finance related, not everyone, but a lot of people who are finance related end up coming across my desk. And then sure enough, 2 weeks later, we're flying back to Israel, and we were actually on the same flight. So that was Ariel's Aliyah flight when he and his family moved here. And that was just us coming home from a Corona summer vacation. I guess I'll just add a little bit of a refresher on my finance background. And I think it's quite interesting because you've already mentioned kind of the difference between what you do and what is accounting and what people here call it and what they know and what they don't know. And I have plenty of stories like that. My background in finance started because my dad is a CFO. He was actually the controller of the United Airlines San Francisco maintenance base when I was born up until 1995. Then he became the CFO of an aerospace company. And then he went into tech and was the VP of finance at Autodesk, then became a CFO, did a few IPOs and was a CFO up until just a few years ago when he retired. And so I grew up not with finance, but with finance. And, my dad's 68. He could say finance. It's, I think it comes with the territory. You take a couple of companies public and that's what you get to do. But it's interesting just the way that these things shake out. And so then my background on the finance side, I got at Morgan Stanley. I did not study finance. I studied mechanical engineering. I like to say I learned how numbers work. I have a great grasp on physics and how, kind of physical numbers move and change. I think most of the physical world can be described through calculus. I relate to that very, very strongly. We'll come back to that later.
By the way, Alex, I think we spoke about this in the past, but I applied to almost all engineering programs. I was very much an engineer. I still watch physics videos on YouTube. And I got into Stern, which just happened to be, the second best undergraduate program for business in the country. So I dropped engineering and went to business.
Well,
but I relate.
I can relate to that as well, actually, because I always was a finance kid. Like I said, I was trading stocks when I was 11. I worked at a hedge fund when I was 16. I was that kid. I did Stanford finance. I was like the only freshman in Stanford finance. But I was always going to study engineering. And I almost did the M&T program at Penn, which is where you get a degree from Wharton and an engineering degree. At the last minute, I was kind of like, I don't really want to do that. I think Stanford's going to be more fun. And I feel very confident in my decision now. That I made that decision in March of 2007. So we're coming up on 19 years. And I feel very good about having made that decision. I took 2 finance classes or finance related classes in college. There was no finance major at Stanford, but there is a business school it's a graduate business school. And so there was a class called Econ 90 that was, what did they call it? It was like accounting for like non-finance people. It was something weird like that. It was like accounting for non-accountants. I don't know, but it was a fantastic, like it was my only exposure to an accounting class. And Ariel, I'd be interested in your take on this. Like everything was practical. There was no just like learning accounting rules, like learning, accrual accounting, cost accounting, there was none of that. In fact, the final for this class was here's a 10K of a real company and a bunch of accounting questions. I ended up working in investment banking after I graduated. And even whatever. I'm not going to go down that rabbit hole of how I ended up doing that, even though it was obviously where I should have ended up. But it was like the most helpful thing because a lot of what you're doing in investment banking, which by the way, we can talk about AI as well. AI could do a lot of this stuff really well for you. But one of the things we got really good at as investment banking analysts was being able to figure out what keywords you could search in a 10K on the SEC website to find these detailed, whether it was option vesting schedules and pricing or adjustments to EBITDA or whatever it also may be. You just got good at hitting Control F and putting in a keyword and finding where that was. And so identifying what's in a 10K from an accounting perspective, what terminology they're using, and then being able to have that actually impact the financial model or the valuation work or whatever you're doing. That was like a absolutely critical skill for me in banking. And so it was like super helpful, super practical. And then I took another finance class in college, which I actually now have a friend who's at Stanford GSB. And I was like, you got to take this class. Finance 335, corporate valuation, governance, and behavior. And I didn't really know what that was. I don't even remember why I signed up for this class. It turned out there was a prerequisite for this class, which I didn't take. And so I was like, everything was group projects. So it was like, okay, I was like hanging on by a thread. I ended up getting like a, whatever, it pass fails. You got like a high pass, which is like an A or whatever. I learned so much about valuation. And I love telling the story. I may have even already told it on the podcast, which is that the professor says, I am a financial economist. I have no personality, which, you know, it made everyone laugh. But he was like, I've never done anything. And this is Stanford GSB. So this, you know, I was still an undergrad, but like a lot of these people had worked for 2, 3, 4, 5, 6, 8 years. Some of them in financial services and finance and accounting, whatever, before they came to business school. And he said, I've never done these things, but I've studied them and I hope you appreciate what I have to share, which is always an amazing way for a professor to start a class. Sets thing off on the right foot. And, you know, it was a business school class. So it was a series of cases and projects. And I feel like we actually learned the theory behind valuation, which was really cool. And actually tying it all together, there was actually a deal in one of our case studies about Gulf oil, which my dad actually worked on that deal when he was an analyst at Chevron before I was born, which was pretty wild how that all comes together. Anyway, so I learned a tremendous amount in that class as well on valuation theory, which hard to think back to banking and how much of an impact that's had, but it had a tremendous impact on my investing career and understanding what is corporate value, like what matters here, right? How are people making decisions around what's it worth? How do we value it? How do we put that in the context of a transaction, which is usually where the only place it really matters, either buying or selling, either part of it or the whole thing. And so I learned a tremendous amount. And anyone who's followed my content knows that I go back to the fundamentals. And really, this class was the kernel of that for me. And so I guess I have a little bit of a unique finance background. I did a bunch of deals at Morgan Stanley, took Facebook public, worked on some debt stuff, worked on some big M&A things where M&A in tech is like, you know, I have a quick story on that. One of the first deals I worked on at Morgan Stanley was selling success factors to SAP. And I had just started. So there were 2 analysts. I was the first year. There was a second year analyst, very talented guy who I think has been at KKR or something for the last 10 years. And he was like running the M&A model. I was like building slides. I called it arts and crafts. And, you know, we're using the comps method and we're trying to figure out if we can use EBITDA multiples and try to figure out a comp set of like game-changing transactions. And like, this is where banker creativity comes in of like, how can you pump this multiple and justify it to the largest extent possible? And it was interesting when I started interviewing for buy-side jobs, they're like, oh, how'd you value this company on this deal that you worked on or whatever? And I was like, look, yeah, we did all this mumbo jumbo, but ultimately there were only 2 acquirers for this company. It was SAP and Oracle. And we were engaged with SAP. And what we wanted to do was really turn this into a defensive acquisition, because as soon as this goes to Oracle, it becomes a bidding war. And so how do we convince SAP that like, you just got to buy this. Here's our clearing price. Let's get it done. And the answer was one of my arts and crafts slides, right? And so some of finance is just like, hey, here's all the logos of SAP customers. Here's all the logos of SuccessFactors customers. Here's all the logos of Oracle customers. And here's all the logos of SuccessFactors customers. Do you want to lose these customers that you don't have yet? Or do you want to gain them? How much is that worth to you? 4 billion, 3.7 billion? Great. And, you know, I still also remember learning how deals actually get done, which is, you know, we had a call with Lars Dalgaard scheduled and the CFO of the company. And it was all the senior bankers and we were all crowded in a conference room at Morgan Stanley. And we had just updated our deck and we were trying to go from, you know, 36 a share to $38 a share. And Lars dials in like 10 minutes late, and we had all been talking through the pages and waiting for Lars to join. And Lars dials in, and you just hear, I got 40. Okay, book's closed. None of this analysis matters. It turns out that Lars had flown to Bermuda to hang out with Hasso Plattner, who was the founder of SAP, in his house in Bermuda. And they got a deal done. That's, do all the work you want, but it's always, I guess it's an important part to just like hit this perspective is just like, do all the analysis you want. But what it really comes down to is like people negotiating a deal and understanding that like there is no truth to these numbers that's absolute. It's really about how do we use these to foster a positive and fruitful negotiation. So I'll pause there. But that's my finance background. Then I joined NEA. I did a bunch of deals at NEA, Series ABC, a lot of software stuff. Anyone who's watching this, I'm sure, is well aware of this SaaS analysis that I've created over the last 12 years. So anyway, I'll pause there.
Yeah, so there's actually a few, I think there was one or two news stories for me, but I think what's really interesting just to compare my finance background versus what yours is. Someone very smart once said to me, strategy and finance are the same thing. It's looking at the resources you have today and just figuring out where to put them in order to maximize your X, which is usually profit.
Well, this is why one of the reasons I stopped using the term finance in general, because people think it's accounting. They don't really know what it is. They think it's annoying. I'm like, I'm just going to start saying quantitative resource allocation instead. And people will be like, what's that? What's
QRA,
quantitative resource allocation? I'm like, oh.
Yeah.
Don't you worry.
Your dad was a CFO. He was doing acquisitions. You took valuation classes and you did investment banking. My dad had a factory in Brooklyn. He had a duplication of videotapes and then moved into CDs and DVDs. And I grew up with a manufacturer as a father. And the first business class I ever took was him taking me to the factory and saying, anyone could sell something, but it's another thing to get paid. So the first lesson I learned was about cash flow.
Net working capital, accounts receivable conversion to cash. There we go.
Exactly. And my point is like finance or strategy. Yes, there's about valuation. It's about the capital markets, about how you're going to raise money and have money in your company in order to go to the next step. You could split it into, they have the three different buckets in cash flow. You have operating cash flow, investing cash flow, and financing cash flow. And so I learned about all three, right? Especially on the operating side. Operating side was never academic. My dad, not an academic guy. And you learned about deals are made by going to the person's house and you have a drink and you have a conversation. What's going on? When you told the story about whether it's going to be one of the two buyers, SAP and Oracle, listen, if you have one buyer, you don't have any options. Once you have more buyers out there, then you're going to have a conversation about price. If you have one buyer, there's no market for it, and they're going to drive down the price to wherever they can. If it's two buyers and they know about each other, you're in a similar position. So it's all about knowing what's actually going around on this. You can say on the street. It takes not just book smarts to understand how to look at numbers and understand what numbers mean. For example, the amount of times I see CFOs taking averages of percentages is shocking. Percentages, you can't just take averages. They're numbers with different bases, the ratios with different bases. It's bad math.
Or just incorrect calculations of growth rates, right? You take year 2 and say it's 5, year 1 is 1. People say 500% growth. No, it's 5x, but it's 400% growth.
No, there's endless examples of bad math being applied, but you have to know from the book standpoint, book smarts, you got to understand what the numbers mean, what they represent. On the other side, on the strategy, you also have to know the street smarts, right? You have to understand what we're talking about here, which at the end of the day, it's a bunch of people trying to do something with their lives, and understanding those interpersonal relationships is extremely important to being able to do successful business and finance. That's why I think there's all these tropes about finance bros. Well, because there's a culture around it. People are going out, they're hanging out.
Got my vest on. I'm repping.
My vest is hanging up in the other room. But I think that's, when you're talking about running a business, when you're talking about having a finance function, you want to have people, you separate the accounting from the finance side. Why? Because you want your accountants to be as straight-laced, as neat and proper as possible. You don't want creative accounting, I think you have a good phrase around that.
I gotta say my line here, which is I'll start it with a story, which is there was a certain company that I was advising in Israel, and I had gotten introduced through a friend whose wife worked there, and he was like, "You're gonna love the one of the executives of this company. He's like a nerd on all this stuff too." So I sat with him, then I sat with the other key executive in the company, and I showed them kind of what I did and what I could do and my analysis. And they're like, "This is awesome. We've been looking for this. We need this. What's this called?" And I was like, "This is called finance." And they're like, "What? No. Like, we have a finance guy. Like, he's over there. He doesn't do anything like this." And I was like, "Let me guess. He worked at EY before and as an accountant?" He's like, "He was an auditor." He was like, "Yeah." I'm like, "Yeah, that's called accounting. That's not finance." And then I explained that culturally they're very, very different, which is that if you are a creative financier, you become a billionaire. That's what happens. If you're creative enough as a financier, you become a billionaire. If you are a creative accountant, you go to jail. There could not be starker contrast in terms of the motivations at the basis of a profession from a philosophical standpoint. And so, yes, accounting is the language of finance, but accounting is very, very different from finance. And it maps directly to math, which is that you've got arithmetic and you've got calculus. The chance that you can understand and do calculus without understanding arithmetic and being able to do that first, very low. I would say impossible, not going to happen. But this is the other problem is accounting is a lot of arithmetic and multiplication. And if you're doing finance in the startup world, what do we want? We want geometric growth. We want polynomial equations. We want exponential things to happen. And so if you don't understand calculus and integrals and derivatives, and you're stuck in arithmetic and multiplication and division, the ability to model it out and understand those dynamics is probably not going to happen. And if you've been trained in a world where creativity is the enemy, I don't care. Honestly, I don't care what any accountant says. If you're a tax person and you want to get creative and live in that gray area, go right ahead. But like if you're in accounting, you're either accurate or you're not. And like creativity, maybe in terms of process, whatever, fine. But like if you're creative, like again, you're going to jail. Like this is Enron. Like this is that ain't it. So sorry, I'll hand it back to you though.
No, but I think that was exactly the point I was trying to say is that once you split out, I mean, finance, the CFO, I would say, has a few different roles under their hat. But already a CFO is a corporate finance person, as opposed to someone who's dealing with the markets or investing and things like that. And so within a company, so we could talk about it as like there's intercompany finance and intra-company, right? The intercompany is like looking at the markets, it's looking at the valuations, it's understanding where financing can come from. You're going from the debt markets or the equity markets, whether it's VC, PE, private, private or public, which is an extremely important thing to understand and have your finger on. Then once you're in an individual company, your CFO, the finance function, is helping you make those decisions on a day-to-day. It's very much related to the strategy piece. Now, the CFO, I would say, traditionally has worn 3 hats. I would say today is probably 4, which is accounting, historical, accurate, nothing should change. Then you have Treasury, which has been long neglected. And then when the SVB blew up the other year, everyone's like, "Oh, you don't have a Treasury function? Aha." I could tell you at WWE, when I was there were maybe 30 people in finance total, let's say. Half of them were the accounting, other half, maybe like 20, let's say 2/3 were accountants, 1/3 was the FP&A, and there was one individual person doing treasury. Treasury, you just need to make sure you have that one person doing their job. It doesn't really, you don't need more than one person, but it's important to have that one person. Let's just put it down that way.
Well,
So there's the accounting, there's treasury, and then you have FP&A, which is financial planning and analysis, is what we're calling finance. That's the forward looking. It's understanding what decisions need to be made, or where money needs to be allocated in order for the company to grow. It's understanding budgets, it's reforecasting, it's running what if scenarios. And I said maybe a fourth bucket, which I would put in, which is a lot of times nowadays you have this data analytics team, but is more on the operational data analytics, which I've seen roll up into the CFO in many companies. Sometimes it goes to a CTO.
I'll add one more,
Okay, yeah, go for it.
which is I would say the span of corp dev and investor relations, which also sits under the CFO usually.
Sure. Yes. So corp dev and investor relations is that bridge to the other market, the intercompany piece, which
Yes.
is also really important. And I think mature again, I guess I'm working too many startups lately, but with the mature companies, you always, when you're thinking about capital allocation, right? There's always a decision to build or buy. And when you're selling your company, right? That's also not something to think about, is that the person you're selling to is also making that decision, build or buy. And what do I mean by build or buy is like, what does it cost me to buy a company that already does this and integrate it versus just building this organically? And so the corp dev function helps you execute on that buy part, right? Also, correct me if I'm wrong, a good corp dev could also have some banking relationships as well. And also the investor relations piece. They'll be dealing with the markets directly,
Those
or
are
I
the
guess
two,
private
frankly,
companies.
those are the two main touch points outside CEO, CFO for investment bankers.
Yeah.
Because either they're, investment bankers on the coverage and relationship side are the access to the investment banking products. And the three main investment banking products are A, buying, sell side or buy side. And then it's debt and equity. And those are both capital markets functions. Yeah, they like to do their strategic stuff, but that's not a thing. So yeah, that's very in line with my breakdown. It's really interesting going back when I was doing consulting before I started Verissimo and I was advising companies. The way that I would kind of pitch myself was that very much in the context of the office of the CFO and I said there's three functions. And I said, there's the accounting, bookkeeping, payroll, administrative piece. Then there's the FP&A piece, which is, I put the data analytics piece under that because,
It should be.
yeah,
I'm
it
to
also
say it,
touches
there's
the
so
accounting
many,
stuff.
yeah.
It also touches the accounting stuff, or it should rather. Often it doesn't, but it should. And the FP&A piece, which I'll link another podcast I did, a short one where I just explain like what I call the FP&A flow from model to forecast, projection to budget, and then that loop between those. And then the third category being that that corp dev IR function. And again, I got called in when companies often wanted to raise money, and I was like, if the data's not good and the numbers aren't clear and the numbers aren't good, like you're in no place to go have an IR opportunity and go raise capital from investors. And my dad pushed back on this categorization. What's really interesting is the piece that he was like, that you're missing that's so important. And this was back in like 2017 was, he was like, you're missing treasury. That's a core function. And so I guess, Ariel just figured out how to, settle this disagreement between me and my dad. As I was like, because when he said that, I was like, it's just part of accounting, like
No,
it's not that
it's separate.
strategic. Like, no, it matters. It also, to be fair, like, yes, we had the SVB collapse and then it mattered all of a sudden, but we mostly work with companies who lose money.
Yes.
Companies who make money need this function. That's part one. Part two is interest rates were basically zero. And because of the terms of financing that you get when you raise venture capital, you can't do anything with that money. When you could put money in a savings account and get 5%, all of a sudden, again, first of all, the treasury becomes like, oh, this is like a thing and we're leaving money on the table. And the second part, again, when we talked about like CFO, CFI, CFF, meaning cash flow from financing, cash flow from investing, cash flow from operations, right? Like all of a sudden that cash flow from investing thing became a thing, right? It's like, oh, our money makes money. Like that's cool.
It's funny.
Versus our
Uh,
operation loses money and our cash flow from financing makes money, then the third thing is just null and void, right? Like, so
Yeah. I was going to say that we had a client start with us a month ago on accounting and also the CFO FP&A side. And by just looking at the treasury position, they've now made money working with us, which is not something you can say often when you're working as a finance function as a back office. But basically, the amount of interest that they're able to get is covering our costs and plus some, their costs for us. But it's an important piece. And also there's just I'm having conversations now with people about, potential downturn in the market. What are the different ways to hedge that? And so having that, just the mindset on being able to understand where your money is, where it's coming. And then, by the way, that treasury piece is one part of it. The other one is working capital management, which is huge. And just to explain what working capital management is that when you're growing your business, you are spending money for vendors, you are receiving money from customers, and potentially you are tying money up in inventory if you have physical inventory. And being able to manage the cash cycle about knowing when you have to pay your vendors, receive from your customers, and also buy inventory could make or break a business. A famous example of this is like Costco has what they call a negative cash conversion cycle, because what they have is net 30 days with their vendors. And what that means, they pay their vendors 30 days after they receive the goods, right? But where do the goods go? They go into their warehouses. Wait a second, what's their warehouse? It's their store. And they have their turnover is 2 weeks. So they've already sold all their inventory before they even had to pay for it. So that's a good business model.
Yeah, the concept of networking capital is one of, it just never gets touched on with startups. And I feel like I'm like the only guy at the early stage who's flagging that as either a benefit or as a real drawback to a certain business model. Where does your business throw off cash by the nature of it, or does it consume cash? And just to double click on that for a second and get a little nerdy on the financing, effectively, you look at a balance sheet and you can see how much accounts receivable is an asset, accounts payable is a liability, and inventory is an asset. And these are your three drivers of networking capital. And we've all kind of been programmed, I hope, to think
There's a
that
few
like
other pieces
assets.
in there, which is the flip sides of accounts receivable and accounts payable, which would be deferred revenue on
Yes,
the liability side, and then the prepaid expenses on the asset side. So
yes. We've all been trained to think that like assets are good. And then I guess it's been kind of all the rage right now to think that like debt is good and like liability is good. But the big thing is like it depends. It really depends. And if you listen to Howard Marks, he's very much like debt increases volatility because your ups go up more and your downs go down harder. Startups, I always say, like, you don't need more. We'll have a whole episode. We'll talk about venture debt. But the way that you actually model these things out when you're building a 3-statement model to try to figure it out is you say, okay, accounts receivable is based on revenue. Accounts payable is based on COGS. Inventory is also based on, no, we base
COGS,
inventory on COGS, right?
COGS. Inventory is usually
Yeah.
COGS. Yeah.
Inventory is based on COGS. As these things grow, you basically can take a percentage. But then the way we express it is actually as days. So now you're bridging. This is a great example where like you're bridging between here's the numbers on the page, here's how we're going to model it forward, and then here's what's actually written in the contracts. And all of these things matter. So like you have a customer contract, if you're consumer SaaS, right? We're using Riverside right now. Fantastic product, right? Like just from the sales side. Now we're just talking the accounts receivable kind of piece of it. You've got the booking, you've got the activation, which is when we start recognizing and earning revenue. And then you have the collection, you have the billing or the invoicing, and then you have the collection. And these all can happen at different times. In consumer SaaS, they really all happen at the exact same moment. As soon as you virtually swipe your credit card, all of those things are happening instantly. RevRec for software companies is as soon as the customer has access to the platform, you can start recognizing revenue. You're swiping the credit card, it's
Maybe.
through Stripe. Oftentimes you have access to that cash instantly. Sometimes you have to wait 3 days. So again, your accounts receivable is 3 days, but the conversion is like super, super high unless you're dealing with chargebacks, which is a whole different part of this world.
Alex, to the point you were saying before about, if you're sending an invoice, let's say you booked the revenue, they activated, you invoiced them, and now you're waiting to collect. It goes back to my first lesson that I learned about getting paid. How many
Yeah.
times do people then deliver the service, give the access to the platform, and the payments just never?
Yeah, and so when you start getting up into the enterprise tiers, and so we'll talk about this initially in the context of software and why. I'll just mention briefly why this gets ignored, right? And the reason this gets ignored in the software world, but it shouldn't, is in part because of what Ariel mentioned, which is this concept of unearned or deferred revenue, which is effectively the opposite of accounts receivable. It's contra accounts receivable. Accounts receivable is you are giving your customers a loan saying you can pay me in 30 days. Deferred revenue is your customers prepaying you for a good or service. And so they're actually giving you a loan for free. Now, people are like, this is so good that, and then by the way, like if you're a software company, like your vendors and the people you have payables to, it's often net 30. So again, you're getting prepaid on the revenue and then you don't have any inventory and you have time to pay your bills. So it's like, let's just not even talk about it. Now, here's where you run into issues though, which is everyone knows intuitively that annual contracts are better than monthly contracts because what we care about is the durability, survivability, margin, we'll talk about that later, of revenue. Because revenue is an invention. Revenue was invented. We didn't talk about this yet. I'll get back to it. We care about money in the door. We care about how quickly and how reliable that money will come in the door. So annual contracts are better.
Just pause on that point. Valuations are cash flow forecasts. And what is the predictability of that cash flow? That's what it is. in a nutshell, if you're taking
We
all
got to do a whole
valuations,
episode on DCFs.
no, but that's what it is. That's what people care about. They care about, am I going to get cash out of this business?
And
We
it's
do
just, it's
revenue
too
multiples,
easy
EBITDA
to.
multiples, because we're trying to deal with companies that don't have cash yet today. But in the end of the day, that's what they're trying to figure out. They're trying to figure out, can I get cash out?
So the mistake that I've seen over and over and over again is bad customer contracts. I don't know if they come from lawyers, if they come from AI now, or if they come from some repository online. But like these companies, when I was advising, they'd be like, "Yeah, we have annual contracts." I'm like, "Well, your cash coming in doesn't look like you have annual contracts." "Oh, well, they pay us monthly." I'm like, "Dude, that's a monthly contract." No, but it says it's a year contract. And I said, "Yeah, and what happens if after 6 months they decide not to pay you for month 7? Are you gonna take them to court? Like, are they going to pay you? No. Like, they're just gonna be like, 'We don't want this anymore. Bye.' And all of a sudden you gave them a discount because they signed up for an annual contract, which makes you feel good, but it actually doesn't really improve the durability of the revenue, anything beyond what a monthly contract might do. Oh, and by the way, there's other crazy things that happen. I heard a story recently from a friend about this who was working at a company, who's currently working at a company, that you need auto renewals in your contracts. You don't want to have a new negotiation, a new sales process. Even if you're on annual contracts getting paid up front, which again is the holy grail of what we want to do in enterprise software. Like if at the end of 365 days, you're starting back to square one and you're not having auto renewal where they just get a new bill and they just pay it and everything stays the same, where there's some agreed upon price increase. Like, bro, you're playing the wrong game. You're fumbling on the one. Like you had this opportunity. Don't give discounts unless the cash comes up front, right? Otherwise, it's just a glorified monthly contract. Like, don't leave auto renewals out of your customer contracts. Like, because then you're not a SaaS company either. It's just the bigger version of that. So this point of, oh, who cares about net working capital because we're a software company? No, you could still mess it up. And the beauty of software companies is twofold. And I've talked about this and written about this extensively, is it's the predictability of the revenue. And what does that really mean? So part of it is grow or die, right? The world of software. It's grow or die unless you're throwing off oodles and oodles of cash. And you can look at the companies and how they're valued who are throwing off oodles of cash. It's not as happy and flowery as you might hope or think, because the margins are never as good as people think the margins are going to be.
I thought
But
SaaS companies have 100% margin.
not anymore. Not with AI, baby. Now they're paying rent to them, the landlords of the 21st. And they always were. It was just cheaper rent. It wasn't prime real estate, which is what these AI models are apparently. So, but they have to get cheaper. Again, another conversation. So, but the issue that you run into is, again, the reliability of the revenue, but more importantly is that it compounds, right? The compound interest thing we've all talked about, we've all heard about, but like the revenue adds up. So we talk about this thing in SaaS. Again, people don't really talk about it that much more. It's just sales efficiency, let's call it. People talk about SaaS magic number. When that idea was invented, it was a very good idea. I think Michael Skock invented that concept of SaaS magic number, which is your net new ARR divided by your associated, attributed sales and marketing spend. So what this is this is like the engine of your business, saying if I'm an investor and I put $1 million in, how many dollars of net new ARR are going to come out? And when I say net new, it's not just new, it also includes all the churn, the downsells, the upsells, and the new customers. And we care a lot about this. But if you just take that as a second, say, okay, if we put $1 million in and we get $2 million of net new ARR, that's great, right? But we had to put that money in beforehand, and so we're losing money. And then we get to 2 million. Okay, great. Now let's do that again. Okay, we're not going to talk about exponential growth, because if you don't understand linear growth, you're never going to understand exponential growth. So this is the power of the SaaS model. Now you have $2 million of revenue that's come in the last year that you've earned, and you've collected the cash on it, hopefully up front. And now you're going to spend another $1 million and get another $2 million. But now if we just fast forward a second to like GAAP accounting land, let's say you earned, again, if you're at 2 million of ARR at the end of the year, if you have a linear curve, let's say you earned 1.7 million of revenue in the year, but you collected 2 million. So who cares? Kind of. It's a little bit of both matter. I know I'm like moving through these numbers quickly, but
Just
now let's fast forward to
people listening understand the lag between revenue and ARR and the cash.
No, we're not going to get into that right now. Just leave it, because we'll get to this point first, which is that, okay, now in year 2, let's say again, you do the same thing, but this year that 2 million of ARR that you had at the end of last year, which you're going to expect to continue into this year, like you just have it. So now on a GAAP basis, if you just think about, okay, we spent $1 million on sales and marketing. We had $2 million of revenue before January 1st. On December 31st, we knew we had $2 million of revenue coming back from last year. So this year, we have so much more margin to play with. We went from a business that was, let's say, spending 50% of its revenue, just again, rough numbers, on sales and marketing, to a business that's now spending, at the end of next year, it's going to be, again, 1 million on 4 million. All of a sudden, our margin halved, of like our sales and marketing margin halved. I hope I explained that like roughly clearly enough. But companies want to accelerate, and so they end up spending more and more, and that's where we hope to get to nonlinear growth. But if you just look at a scaled company, there's a bunch of public software companies that grow less than 10% a year. Their magic number, if you just look at what their revenue growth was from one year to the next, like the absolute dollars, and then you look at like, let's say you look at 2024 sales and marketing spend, and then you look at how much additional revenue they did, from 2025 to 2024, you're like, this magic number is garbage. But yeah, they're growing 10% a year and they're on $1 billion revenue base. But like, who cares? They don't need the good margins anymore. These things matter a lot when you're at small scale, and they don't matter at all when you're at large scale. And so that's why, we could have a whole episode about this, why like these hack metrics, these quick diagnostics, when you're growing from $300,000 of ARR to 2 million of ARR in a year, matters in one way. When you're growing from, let's say, 50 million of ARR to 80 million of ARR, matters in a different way. And we're growing from like $1 billion of ARR to 1.1 billion of ARR. It matters a whole different way. And so, like, again, this is where the nonlinearity and being able to understand these things matters so much. The number of times that I've talked to like Series A, Series B, honestly, I'll just say it, Israeli CFOs. And I've talked to, it's not really fair. Most of my professional career at this point has been in Israel. So I've talked to more Israeli CFOs than I've talked to American ones. But because you don't have a big like investment banking private equity pool that's driving into CFOs, and there's not like a big culture of people coming through FP&A ranks like Ariel did. And so you just get a lot of like PwC people who then move into finance, and that becomes the ethos and the culture. But anyway, I remember meeting a company, a growth stage company, and I was with a couple of other investors, and they kind of brought me. I was at the time, like, frankly, I was in yeshiva, not even working. And they were like, come with us to this meeting. And the CFO was just like, no, we're going to do this and we're going to get that. And I'm like, no, but don't you want to like do this? Like, I'm making a curve motion right now. Don't you want to, have it curve up? No. We're just going to do this. And I'm like, yeah, that company's dead now, literally dead. Because, when you're in grow or die, it's not just that simple. It's nonlinear growth or you die. Like, if you think you're going to put just one foot in front of the other and you're never going to accelerate, like, it's going to be a long road down in SaaS land. So again, that we'll couch that as like mini rant number one. I'm wondering if there's specific things there. I'm sure, Ariel, you have some things we should unpack from that, because I think just from that discussion, probably have 6 hours of content. So everyone buckle up. It's going to be a Rogan episode. Let's go.
I'm trying to think of which part to double down on, but I think I kind of want to talk about the linear versus nonlinear growth, and maybe SaaS land is not the what it was. And
but by the way, I started this off by saying let's just talk about software. But now what we took for granted in enterprise software, which, as the acquired guys always say, and I couldn't agree more, it is the greatest business model of all time. Enterprise software that's legal, and but the business models are getting different now. The math isn't working the same. And I heard a crazy take on a podcast recently, which is like...
Wait, before we drive too far, remember the hot take? Something I did want to say about the deferred revenue net working capital that we did mention before is that, as I'm working with a company and trying to fundraise, trying to extend their runway. And so there are a few levers that you could pull to extend runway, which is understanding increasing net working capital is one of those levers. How do you do that? Well, you start implementing upfront payments. Once you start upfront payments, you could...
Decreasing net working capital.
No, you could increase, you decrease, well, because you're increasing net working capital in terms of how much money...
This is like a very confusing thing, so we'll just take...
So I'm thinking in terms of increasing your receivables, but you're not increasing your receivables, you're decreasing your receivables, but making it go negative. You're going to the deferred revenue side.
And I mentioned this
part that I was talking about earlier.
Exactly. Assets are good, liabilities are bad. Well, free loans are good.
Right.
And so owing you a lot of money and you not having cash to pay payroll is very bad.
Right. So you decrease your network capital, meaning you decrease the amount of money that you need to invest into the company to keep it going, because you get so much money out of the the upfront payments, you have now a balance of cash. So by just switching to upfront payments for, brief periods of time, even if you do quarterly, not just annual, you could extend your runway. You could have extra hundreds of thousands of dollars, depending on your size or your speed, just sitting on your balance sheet and sitting in your bank account, which is where you want it to be. And you could use that to extend your runway.
Yeah, and that's, again, it's an important concept, is that like businesses consume cash. Like they consume and use cash. And so the probably the right way to think about it is like how much money is tied up in just operating the business. And that's where, like, again, when you see an M&A deal, you see there's like restricted cash sometimes. Now, sometimes that's covenants for debt or whatever, but sometimes it's just like there's cash that you need to run the business. So yes, there's a what we used to call Morgan Stanley aggregate value, or enterprise value. They mean the same thing, right? That's different from equity value, right? So you can net cash against that, because if you buy a company, let's say for $1 billion, and it has $200 million, because you buy all the stock. So you buy all the stock. Let's say there's no debt. You buy all the stock. It's $1 billion, but the company has $200 million of cash on its balance sheet. You only paid $800 million for that company because there's $200 million on the balance sheet. You just put that on your balance sheet, and so it didn't cost you. But you can't put all $200 million on your balance sheet. That company still needs cash to run. They need money in the bank account to pay for things, to pay employee salaries, to pay rent, to pay vendors when they need it, to just have a little bit of a cushion. These things all matter in terms of the practical side of running a business. And I'm going to hark back to a comment I made earlier, because I think that this framework is really useful for our conversation, which is you've got the practical, how deals get done. You've got the academic, and then you've got the analytical. And like these are kind of our three approaches. And I think part of the reason that finance needs to be demystified is that the ethoses of all these things are very different, and the personnel are different. And this is why it takes 15 years to become a CFO. Like, I mentioned my dad, like he was the CFO of an operating business inside a conglomerate. That was his first CFO role. But before that, again, he was a controller. Before that, he was an analyst. So yeah, there's a bunch of different steps that you need to go through to grow out these functions. And frankly, a lot of people that are becoming CFOs now, they don't have the full gamut. It's not reasonable to expect someone to have depth at every single function inside the CFO role. More likely, it's to know enough to be dangerous, and then to have your guy. So like my dad always had, like, he didn't come through the accounting world like a lot of CFOs have. And so he had like a chief accounting officer that he brought with him, like everywhere he went, you know? And then at one point, that chief accounting officer went to a slightly different company that is worth like $80 billion now. And he's the most successful chief accounting officer in the history of the job title. Anyway.
But I resonate with that, because that's kind of how we operate at Raftel. Like I have a CPA, but I'm not the accounting guy. I know enough about accounting to get by and be able to look at it and know when something's up. Right? I could do some forensic accounting stuff. That being said, I'm an FP&A guy. I'm a CFO. I'm not a capital markets person, but I have a capital markets person. I'm not a guru, but I have the M&A gurus. And so whenever we're coming in on a deal, we have the CFO with the specialized hat that could come in and we're, joining together on the team, which is very different than having someone in-house. If you have someone in-house, you have to hope that they're wearing as many of those hats as possible. And so that's why I kind of like what our model is. It allows us to go deep on those different areas that a CFO needs to go on.
I mean, I'll compare it to like this concept. No, we're recording something out now. Can you go back outside?
No, but I want to hear what you're talking about.
Okay, so you need to sit on the floor and stay super quiet. Can't make any noise. Okay. Okay. So I'll compare it to this like idea of being a product manager and owning a product. And what is a product manager? They say, oh, it's a mini CEO, right? Why? Because they understand marketing and sales and engineering and design, and they bridge all these things, and they can kind of hold their own in each of them and manage to a unified goal across these disparate functions. And it's like, yeah, CFO kind of has to do that too. It's just all different flavors of numbers, but it's very analogous in that way. Like it is a multifaceted thing. And I think the mistake that you make, or not that you make, but that the mistake that a lot of founders make is just being like, oh, that doesn't matter right now. And it like, well, not all of it matters right now, but some of it certainly matters right now. Like, do you even have the opportunity to make money? Let's talk about that. That's one of my main things.
harping on that point, I think obviously the earliest stage companies, they need to try to find product market fit, right? And so they're kind of going all over the place and trying to figure it out. And their main, challenge or opportunity to use finance is to see. Actually, this is a great example. I had someone visit the office today, a good friend who's starting a company. And he's like, I just need a basic model. And I call it scratch paper. It's a model that basically tells you what you need to get done to get your goal. So my friend's goal, I want to make $100,000 in December. Now, what does $100,000 in December mean for you? It means essentially their run rate. Like if you think about it, it's not all MRR. I'd say most of it, half of it was MRR, but it's first year of a business, solo entrepreneur, no VC backing. And so we laid out the math and we're trying to figure out the pricing. If you're spending $10,000 every time someone onboards, if it's $1,000 every time for maintenance and, people staying on with you. And so we were able to start building out the math and you're like, okay, so based off this, you need 50 clients by the end of the year on retainer plus, 6 new projects on that month. That's how you get to 100K. Oh, okay, 50, I could do that. That's 50 divided by, 10 months or whatever it is, 5 a month. And I was like, well, it's not really 5 a month. It means you're closing 5 a month, which means if you have a 10% close rate, that means you have to be talking to 50 new companies every month, but that's not that month. You need how long's your sales cycle, right? Oh, it's 60 days. So you have to start talking to 50 companies 2 months in advance of, in order to get to your close. And so you have this conversation, which is a strategic conversation, but it's also a finance conversation that you need at this early stage. Then once you go up and you actually start having business, you're having, invoices coming in and payables going out, you need to set up these systems because otherwise you start building up what's called organizational debt. What is organizational debt? It's a type of debt that you don't know how big of the loan you took out. And you also don't know when the maturity date's going to be. But my God, you're going to find that when it does hit, you're going to feel it. And when you feel it, it's usually around, hopefully you don't lose your company, but maybe you have to fire half your staff, which is a very shocking thing. Or maybe you end up getting sued into oblivion. But so the way you avoid organizational debt is by investing into organizational things, which is including, it's legal, it's HR, but it very much is also finance. You need to have good accounting. You need to have good processes around your finance, your payables, your receivables. And that's extremely important when you're setting up these companies. Then only once you have the baseline, I forgot what the name of the person was. It's not my idea, but it's kind of like Maslow's hierarchy of needs. It was a company's hierarchy of finance. And so the bottom layer is bookkeeping, it's accounts payable, accounts receivable. If you have the ability for money to go in and money to go out and to just stay compliant with the law, that's level 1. Level 2, reporting. Can you use those numbers for getting the reports out to see what's going on in a company? Only then you get to FP&A, and after that you get to strategy. And the idea there is that, well, first of all, it's another thing that we talk about. I don't know, we have a whole podcast on this, which is garbage in, garbage out, right? If your books are just compliant, which is, by the way, how most companies are doing it, especially in this country, you can't use those numbers to understand what your business is doing. They're just compliant with the law, and they don't actually reflect what your activity is. And so making sure that you invest. Yeah.
Yeah, I have stories about this where, I'm working with companies and trying to help build their models. And I'm like, you got to go yell at your accountants. Like, they're using outsourced accountants at this stage. And like, there's no it's just like one line for like payroll. I don't know what departments they're in. It's just like nothing's split out by department. Nothing's like, nothing's accurate. And then I'm like, well, guys, like, you got to do better than this. And then the founder was like, yeah, this outsourced accountant sent us this list of questions, which is good because, right, like, this is what a bookkeeper needs. Like, here's a list of questions, like, to clarify that information so we can split it into more detailed buckets. It was 400 questions in a spreadsheet. You think you're going to take a CEO's time? It's like, well, this is an unsolvable problem. And I'm like, well, it's really not unsolvable. And it requires, and frankly, I think the best solution to it right now is probably Ramp. Like, Ramp's done a tremendous amount of work in this area. AI can do this extremely well. Like, you have one person who's just like, hey, tell me what this is. And you answer the question once, and then AI now knows it. And then boom, it's in the ethos. And like, for Ramp, it's, again, they've got thousands of customers and they're all spending money on relatively the same things. And so if they learn what one is, they know what it is for everyone too. And again, how you allocate these things, sometimes it's just, you got to ask the question in a way that's like easily answerable. 400 questions in a spreadsheet. CEO should, I would be upset if the CEO was like, yeah, I pulled an all-nighter answering all these questions. Be like, oh my gosh, what a
Yeah.
waste of your life. That's not going to
I
drive the
mean,
business forward.
yeah, the bookkeeping is a big part of it. And part of even before you get to the bookkeeping, you have something called the chart of accounts, which is like what you mentioned with the payroll being one line. You need to organize the chart of accounts in a way that makes sense for your company. An example of a really bad bookkeeping just reminded me of a horror story where the accountant sent over a report and there was a line in COGS and the cost of goods sold of negative inventory cost, like, which is a positive. It was just, and it was hundreds of thousands of dollars a month. I had no idea what in the world this line could have been. And we found out that it was just like whenever they just put money, they were revaluing the inventory on a monthly basis, and they were just throwing the expenses like kind of like on a dartboard, just kind of like, okay, that's where those expenses are going. And it ended up with these negative COGS balances. It was unbelievable.
And this is just to tie it up here. I think that we'll probably kind of focus on this one point, and then we're going to record more here soon. I know, which is like, if you don't understand how numbers that you're measuring are going to be used, you're probably not going to measure them properly. And that applies in science, it applies in finance, it applies in business modeling. I get people ask me all the time, of course, right? Like, I'm the pre-seed seed guy who like focuses on business model. And people are like, well, how do you build a business model if you don't have any, financial data for the company? And I'm like, how do you know what financial data to collect if you don't know what business model it's going to go into? Do we care about collecting data for the sake of collecting data? Like, no, we don't. Again, you have to be compliant. Yes. But don't think that's the most valuable thing you're doing with your operational data. That's fumbling at the one. If there's one takeaway from here, it's that. It's that, like, again, your business model mandates what data you collect and how that data is defined. Yes, you need to be compliant. That might be a different function. You might need to be doing this twice. Fine. The accounting rules are old. They're not up to date and up to snuff with all the newest, coolest, fanciest business models and what really economically is going on in terms of how these companies are earning and making money. And so, yeah, you might have to do it twice. And that's where, again, you referenced this earlier of like that data analytics person. In theory, and like I mentioned, they should be working with accounting and with FP&A. But if accounting's doing their thing and it's compliant and it's accurate for the purposes of accounting and tax, great. But if it's not helpful for mapping to the business and being accurate to what's actually happening in the business, then you ain't going nowhere.
Yeah. And I think to add on that point, data analytics must be working with finance for definitions, because you could have situations where the CEO is looking at these dashboards that the data team is putting together, but it does not reflect the actual financial reality of the company. And it just reflects maybe some data sources like, oh, they were pulling from a Stripe integration. Great. Now we're going to rerun some numbers. At the end of the day, that cash is not in the bank, or the revenue is just not there, or there's so much bad debt going on and it's just not being caught in those numbers. Or what I've seen is just the definitions of balances change. So for example, are you looking at your customers at the end of the month, or are you just looking at a customer who popped their head in the window during the month? Active customers versus customers that are actually there versus
Not so simple.
customer who
Defining these
showed up
things.
for 3 days and decided to leave. Like, how are you counting all this stuff? It's not, you think it would be easy, and you think it'd be done before, but every company is different. Benchmarking is almost a waste, it's just a waste of time, because guess what? That other company, and this is Alex.
I would argue, well, yeah, benchmarking is a complete and utter waste of time. And
Right.
no one
That
can
other
ever
company is not your company. That's great. Now you compare to yourself to a company that is not your company. Great job.
So they're doing better than you. What are you going to take away from this? Or, oh, they're doing worse than you. Okay, so now you're just going to give up and be like, no, we're good. Now I can go to sleep. I don't have any desire to get better. Anyway, I'm very anti-benchmarking. I think benchmarking is helpful for people who sell data, like, Preqin or whoever, or these
Partner.
type of things that are absolutely useless. They are helpful for people who are bad investors who think diagnostic, quick and dirty things. Oh, it's in the top quartile of this based on this report, and somehow you're going to make an investment decision. All that again.
Payroll is a percentage of revenue at this company at this stage in this specific sector. I just don't know, man.
The headcount growth is
people.
growing quickly. The only places that it's useful is when you need to do something for the market. That is market. So like sales compensation, like, yeah, you got to know what other people are paying salespeople and how they're achieving, because you're going to have to pay those same salespeople. They're going to churn through your doors and their doors. So yeah, it's useful there. But if it's not something that actually is mandated by the market, which again, the ins and outs and the details and the complex ratios, compound ratios inside a company are so nuanced. I'm not saying never calculate LTV, but never calculate LTV in a way that you read how to calculate LTV online. Like, oh, this is what the Bessemer report said is how you calculate LTV. It just doesn't matter. Again, I realized that a long time ago, and I created this whole new way of calculating LTV, which is also not useful, right? The reason to calculate LTV is to compare one customer or one group of customers to another customer or group of customers inside your own customer base to figure out where you should be investing your customer acquisition dollars to optimize for the durable revenue of your company in the long term. It's not our LTV is this and our CAC's that, so I can sleep well tonight. Like, yeah, if that's how you're running your business, good luck.
Yeah, no extra comments on
There's
that.
so many rants we could go on here, but we covered a lot of good points. I would say that in conclusion, the things that we talked about today are the culture of finance. What is finance? What is this thing called finance? How does that relate to accounting? What is the cultural and ethos and philosophy behind finance? What are the different roles within finance? And and then we spend a decent amount of time talking about how you can mess all this up because of a lack of clarity of what these things mean, why they matter, how to look at them. And so we'll cover a whole bunch more subjects in our future episodes together. We'll cover horror stories. We'll cover glory stories or whatever we want to call them. And then we'll also get really tactical and give some really clear tactical tips for how you can build your business model, how you can not mess these things up, how to evaluate outsourced accounting firms, outsource CFO function, and how to make sure that you're not going to be totally blindsided either it's at Series A when an investor asks for something or when you run out of money. Anything you want to close up with, Ariel?
I think that in the end of the day, if you're thinking of finance just as getting my taxes done, then I think you're missing out on an opportunity, not just opportunity, but the idea of how you allocate your resources in your company in order to optimize your valuation. That's what finance is, and that's what strategy is. And this goes from not just your unit economics. It could also go into as a CEO or a founder, it could go into how much of the company do you own in the end of the day. Right? Understanding the capital markets, the financing, raising equity, or really what I call selling a piece of your company, going into debt. There's dilution in there. There's understanding the return on investment from your personal level. This is all part of the conversation, and that you have to think about it on the company level, on a founder level, on an employee level, and it's just the tip of the iceberg here. And I'm excited for the future conversations.
Yeah.
A lot of rants to do.
All right. Thank you so much.